So
Very good. Well, good morning, everybody. Thank you for joining us for another edition of our real estate backstory. We do this every Monday morning around 9 a.m. and we kind of talk about the comings, the goings, and the try and pull back the covers and expose the soft underbelly of the real estate world. So my name is Alan Richardson. I'm the managing broker here at Maximum One.
my name is Ming Richardson, the compliance broker from Maximum One Realty and Realtor Partners.
And we're really glad you joined us. So this has been a really interesting week when it comes to especially in the housing, because we've had such all kinds of crazy things going on in the past week. And so we kind of want to kind of give you guys a wrap up, a synopsis of kind of what's been going on. And so we kind of started off, like last week.
Big news.
Well, there's so much different news. So, but last week, midweek, Jerome Powell, the Fed chair, he went in front of Congress. And when he did that, he talked about the Fed was really looking to be rather hawkish in their overall stance moving forward. And boy, that made the market just kind of go, oh, really kind of funky in there kind of thing. And so, and so what we saw was that then we saw interest rates that really kind of, they moved up a little bit again. And so we saw where the 10-year Treasury moved up last week. And so, when you put those kind of things together, it was looking like a weird week, right? But then all of a sudden, and so then on Friday, Silicon Valley Bank, SVB, failed. And so we want to talk a little bit about that too. But as soon as that failed, then the treasuries dropped. And so because mortgage rates follow the treasuries, mainly the 10-year Treasury, but the 2-year Treasury, the 5-year, all the treasuries just boom, plummeted kind of thing. So we saw interest rates drop by nearly half a point.
Honestly, this weekend, as wet as it was, we have more showing this weekend because the rate dropped. So good job to the lenders out there who keep their buyer informed about the rates and locking them down.
Yeah. But let's talk real quick about the SVB, okay? Because first of all, understand that banking is really safe. Like there's no issues with what's going on in the banking world. This was just kind of like a good old fashioned bank run. I know it sounds like, and some folks just don't, understand how kind of what goes on in banking. And so I'm not trying to talk down to anybody, but it's, when you put your money in a bank, the bank doesn't leave that money sitting there. They take that money out and they go out and they invest it and they invest it, normally speaking, in safe investments and long-term holds on things like that. And SVB did the same thing. The challenge for SVB, it's Silicon Valley Bank, right? And so all their investors, the biggest people are all these big tech players, all this venture capital funding, and especially in the tech market, if you look at what's really happened to stocks in the tech market, they've just taken a beating. And so they've been pulling a lot of cash back out of that bank. And then, SVB had all these investments that were, because with the rising interest rates, they bought treasuries and things at a very low interest rates, and we're going to lose money if they sold those treasuries off, which they had to do. And so basically more and more people went to the bank saying, I want my money. It's kind of like, like the old Christmas show, It's a Wonderful Life, when everybody makes a run on the bank kind of thing. And so it basically ran out of money.
You just date yourself.
I'm totally fine with that too. Yeah.
It's a classic movie.
But the whole idea is that $42 billion was taken out of SVB Bank in one day kind of thing.
And you can see how that makes the bank fail and unstable.
And so the Fed came in and they closed the bank down, captured, and so most of those folks are really going to get their money back, even though a lot of it's past that $250,000 that the FDIC insures for. But there's still some decent assets in there. But really what we want you to understand is that because a lot of times housing and banking are pretty closely tied together. Just because this bank failed does not, like this is not 2008 when the government had to bail out banks and there were so many issues like that. That's not what's going on here. This is a very isolated incident kind of thing, and they kind of got caught with their pants down. They got caught having too many investments out there and not enough cash on hand.
Right, not enough reserves.
Yeah,
basically.
Exactly. because, one thing that, like, as Ming said earlier, at the same time as all this is going on, guess what's happened? Mortgage applications are up,
I
right?
mean,
So,
it shot up this weekend.
and so total mortgage application volume for last week was up 7.5%. That's before the rates even started to drop. And so we are glad to see that kind of going on. But one thing that to kind of understand moving forward is that there's this thing called the MOVE index. And so it's basically the Merrill Lynch option volatility estimate, which basically just says, hey, in the treasury markets, how crazy is things? And so, like, it sits at 140, which is like, it's just a benchmark, but it's up 40% since February. It just basically means that the treasury market is nuts. It's just freaking nuts. And so anytime the treasury market is nuts, what does that mean for interest rates mean?
Well,
nuts. Right. Yeah. It's just really kind of the only way to kind of put it in there. Is it's just a really weird place for
right now, just because, with the Silicon Valley bank failure, it has created a influx of mortgage rate going down.
Well, and at the same time, the Fed, everyone knows that the Fed meeting is coming. Yeah,
to control the inflation.
But the Fed is the Fed's gonna be meeting again later this week, and so everyone was expecting them to raise it by 50 basis points. Now they're thinking they may only raise it by 25, and so the markets are responding very positively to that. And so, but realistically, interest rates at the end of the day are really going to be based on inflation. And so as we see more, inflation come into control, it's Treasury, same thing. Yeah, exactly. So, all right, let's move on. So, at the same time as we saw mortgage applications increase, we're also seeing where both home buying and home selling as far as consumer sentiment are trending down. Like as far as so every month they go out and they poll, is it a good time to buy? Is it a good time to sell? Correct. And basically it's 79% believe it's a bad time to buy and 44% believe it's a bad time to sell. So these are not great places that's really, but a lot of this is dealing with consumer confidence, how comfortable people feel with it, with their jobs, with the economy, with things going on, with the overall housing market, that kind of thing. And so, as well as some of the information that we see out there, because you also see this thing CoreLogic came out and they released their, what happened with property values in the last year and kind of what they're predicting moving forward. And so nationwide, property values are down 0.2%. And they're predicting it, for it to be down 0.1%, but still up 3%. Yeah.
Now, year to year, they forecast 3.1, but right now we're doing a 5.5, so it's still a little bit better.
Yeah. But that being said, understand that when you see these national numbers, that's not us. As a matter of fact, this is also from CoreLogic, and you can see that the areas in blue are representing where property values are lower, kind of thing, right? And so you can see that the closer to red you are,
the better you are.
And so Georgia sits kind of solidly in that 7 to 10% property value appreciation year over year. And so pretty much the whole South is pretty much that way. And so we're sitting in a like when you see the national data, just remember that we are not we're not the West Coast. And so we don't have those same kind of issues here. We have a lot of positive attributes and aspects to what our market is really looking like.
That's correct.
So, when you look at overall, still, and these are national numbers.
Right.
Yep. Our
average price. So we're still up by
we're still
1.2.
Yeah. So we're still trending up. Even as a nation, we're still trending up.
And also for nations 1.2, we're probably sitting a lot higher than that, just because where we are.
We're closer to 6. So now, at the same time, there was a new study that came out that said nearly half of all U.S. households can't afford to pay more than $250,000. We kind of bring that up, while talking about this, it's simply because that's like the magic number there, and we're seeing in our marketplace anything 250 and less, as far as like how balanced is the market, that kind of stuff. If you have a house that's under $250,000, generally speaking, you're getting a lot of interest on it because we just don't have enough properties under that $250,000 price point. And so that is kind of a magical number. If you're going to list at 250 or you're going to list at 251, you want to list at 250, right? Because, if you can get there, I mean, there's so many more people that are looking to buy
Right.
under that price.
You'll generate more interest for the property.
We are. And so that's a big deal because there's a significant gap from 325 to 250 as far as how many people can afford to buy at that price point. So pending sales are still down. They're down 16%, but however, that is nearly half of where it was. We were down about 33%, 34%. So we are still seeing pending sales. Our trend is improving, but it's still not where it needs to be. New listings of homes, and this is one that we, at first Georgia was we were trending up with new listings, and now we're back down to where the rest of the nation is. And so
that's because most sellers don't want to give up their great interest rate. And not only that, they're facing the same thing as a buyer.
Yeah.
I mean, right now the interest rate is high and the value still climb up.
Right. But as we see interest rates soften, we are going to see more new listings come into the market.
Correct.
And so, overall, our total listings, are up 18% year over year. And so we are still traditionally or statistically way lower than we've been in a very long time. Overall.
So there's still a seller's market up to a certain point, and then it becomes a even market. And a luxury product, it is a buyer's market.
Well, and we'll go into luxury in just a minute. So 45% of our pending sales are under contract within 2 weeks.
Yep.
This is our benchmark for listing agents out there. So if you have a listing and it's not under contract within 2 weeks, it's probably price. And
sometimes it's a deferred maintenance.
It can be, but price versus condition always. But
correct.
But how do you fix property condition? Price. I mean, that's either you improve the property or you have to.
In today's market, because of high interest rate, I can tell you right now, buyers are putting more down payment and therefore will not have the money to do repairs. So it is important for listing agent to know that those deferred maintenance is the seller will get more money out of it if they would just fix it.
Right. Yeah, they are not going. I mean, in this market right now, our buyers are not going to pay top dollar for a property that is not in top dollar condition. Correct. Basically. So now 23% of homes still are being sold above final list price. And so, it's down from where we were in 2022 and 2021, but we're still really good, right? But we're still, we're higher than we were in 2020. 2020 was still a really good market. This is back still pre-COVID that we're going against on there. And then we saw where price reductions had dropped some, but then they jumped back up. And so, they kind of moved back up on a little bit. Indication
of the interest rate.
Yep. And it makes sense. It does follow along with those same kind of trends.
A lot to do with it.
All right, now let's get into some more practical things, kind of stuff going on. So we want to talk really quickly about homestead exemptions. And now it might be like, why are we talking about homestead exemptions now? Well, basically, you've got about 2.5 weeks to reach out to your client, to your past clients, right? So applications for homestead exemptions are due by April 1st. And so this is a really big deal. First of all, for realtors, this gives you a great opportunity to make that call, to reach back out to your past sellers or to your past clients and buyers and say, hey, it's time to make sure, have you filed for your homestead exemption? Do you have everything you need to do that? Has to be done by April 1st. How's the house? Do you have any problems? Anything I can do? Oh, by the way, anybody else looking to buy or sell real estate? Correct. It's a great time to reach out and engage and talk to everybody.
Please schedule yourself out first thing in the morning. Call, leave a message if you can't reach the homeowners and remind them the homestead exemption. You can search a website on whatever county that you sold the property to and look up homestead exemption form from that county. Yeah.
Now at the same time, one other thing that not the same time, but so like this is just specific county information. So again,
Bartow, Cherokee, Clayton, Cobb, it goes down the list.
And so we'll put these links onto the comment section underneath the video. Sorry.
Hard time talking.
Yeah. Brain's just kind of semi-functioning.
We leaked an hour ahead, so we're a little.
We all feel it today, right?
Yeah, pretty much.
But we'll put these links in here. And so if any of your clients have questions about Where do I go to apply? What is the process? How's that all work? We're going to have all the major Atlanta area counties in here, as well as the links for all those, and you'll be able to find that in the comment section.
Absolutely.
All right. Now, speaking of daylight savings time, you need to update your super lock boxes for daylight saving time. And so if you have your super turned on to where it can only like nobody can access it till 9 a.m. Well, suddenly they can't access it till 10 a.m. And
Yep.
so if you don't go and adjust it in there, then guess what? You're going to be getting that phone call like, your super's not working, it's broken. Why can't I get in? That kind of thing. All right. So there's a new study out, and this is from Redfin, where they share out that the typical U.S. homeowner is spending 12.3 years in their home. And so that's actually down from where it's been for the last few years, kind of thing. We're starting to see that trend move back down.
I think with the COVID and everything else, the great interest rate and the rising home prices, a lot of people are flipping their houses within 2 years.
Well, but it really kind of depends on the age of the homeowner. And so when you look at folks who are, a homeowner that's under 35, 50% of 35-year-olds and less are selling within 3 years.
Yep.
And so, when you start looking at the folks who are 35 to 64, a lot of our Gen Xers, things like that, you'll see that, somewhere between the 4 to 7 and 13 to 22 is a big deal. Now, once you start moving up to 65 and older, 35% of those folks have been there 30 years or more, kind of thing, before they sell. So it really kind of depends. Now, here in the Atlanta metro area, 10 years ago, it was 10.3 years. And then in 21, it was 9.5, and now we're at 8.7. So we're actually, less than the national average. Here in the Atlanta area, it's around 8.5 years. And so it's good to see that number is kind of, we need that the houses to kind of turn over. That really does kind of keep the whole housing market really, really rolling for us. So rent growth is slowing. And so we've seen that, in the United States, the median U.S. asking rent is up 1.7 from a year ago. However, that's the smallest gain since, 2021 kind of thing. And so we are, you can see kind of what's been going on with rent growth for the last couple of years.
What it did last year, bro, this time it was 17.5.
Yeah, but
that's huge.
Well, same thing we saw with property values, right? And so what we're seeing is now these numbers are going to start to be reflected in the inflation numbers, because if you look at one of the biggest factors that drives inflation is housing, is where people live, both on rentals as well as overall housing costs, period. And so seeing rent growth slowing and softening in there, and knowing that once inflation kind of comes more into control, we're really going to see interest rates moving down. I'm really glad to see that the largest sector that affects interest rates, or that affects inflation, is going to be, we'll see that number moving forward. Now, how often do our renters move? And so this is a really interesting study that came out. And so, the typical U.S. renter spends 2 years in their rental property. Now, that doesn't mean that they go buy. That just means that they tend to stay in a property for 2 years.
And then they move.
And so this is very different from homeowners that, we just said it's 8, a little over 8 years in here in Georgia. A typical renter spends 2 years in their home. And so the good part is that when renters are thinking about moving, they're going to consider buying. And so that's a good time. Every couple of years, our that rental market almost turns itself over. And that's a great opportunity to kind of talk about the power of homeownership. And we are going to be talking about that. We have our sales meeting tomorrow in all of our partners' offices.
Absolutely. Please come join us, even if you're not an agent of ours.
Yeah,
we'd love to, we actually share some more data, and also you'll get some really good marketing tips and everything else in the office. So
that's one thing we're going to be talking about in great detail tomorrow is like why buy? Why is it better to buy than it is to better to buy than it is to rent? Like what are the positive attributes? Why should I do that? Because in the past month or so, I've had so many agents coming to me like, I've got renters that are sitting on the fence and trying to decide, should I do this? Should I not do that? And so we're going to be spending a good bit of time talking about why buying is still the right choice for most Americans. So luxury home sales, Ming started talking about that, but luxury home sales are down 40, almost half. Okay. So the total, now this is the volume of sales. And so, luxury, anything over $1 million, that kind of stuff, but luxury homes are down really significantly just in the overall volume of homes being sold.
But if you think about it, a lot of people, when the interest rate was 3%, oh my goodness, they can afford a ton of more purchase price based on the same monthly rent. And that's why you saw such a huge spike in 2021, 2022 on luxury home. But now, obviously, with the current interest rate, that number has dropped down tremendously.
Well, but we have such like differing data, because at the same time as we've seen this massive drop in luxury home volume, we actually saw luxury home prices increase higher than non-luxury. So like at the same time as we've seen this volume just fall off a cliff, property values are still up 9% year over year, as opposed to
that's why not a lot of people buying.
well, but at the same time, one of the areas and this next graph is going to show is that at the same time, luxury home supply is now at its highest since 2015. So just the total. So I am kind of expecting that we're going to see luxury soften a little bit more. For us, I think we got 3 or 4 listings over $1 million just overall in the brokerage right now. And so we're kind of really paying attention to that. And so, luxury is still an important segment of overall housing. Right. And so we are seeing where luxury, and if you deal in luxury, understand that there is more oversupply right now in luxury than we've had in 8 years at this point right now. And so anytime that, for real estate, it's still supply versus demand on there. And so if we end up with a whole lot of supply and not enough demand,
and it's going to drop.
Yep. So at the same time, we're seeing this same exact 7% of U.S. homes are worth at least $1 million. Now that's down 8.5%. And so where we are seeing where overall property values have been softening, those kind of things. But we've also seen where for a lot of sellers, they're just not putting their home back on the market right now. Now, I kind of want to wrap up with Open Door released their financials for the end of 2022, and so for the quarter, so for the remaining 3 months of the year in 2022, they lost $1.4 billion. Now I'm not sharing this information as like, yay, Open Doors taking it on the chin. They did. But understand that, like when you see Open Door in our marketplace, and they are in our marketplace, we're seeing Open Door act, and actually all the iBuyers act much more like traditional brokerages. And that's because they are losing money in a lot of ways. And so we're starting to see where they're being very selective about the homes that they're buying. We're seeing where they're being very like if a property sits on the market, they will reduce it because they cannot sit on inventory. So I'm not trying to say it's good, bad, and different. I'm not trying to bash Open Door by any means, that kind of stuff. But that being said, like when you're operating or when you're engaging with Open Door properties, that kind of stuff, understand that they are there's a lot of changes going on in Open Door. And so if you're submitting properties for your clients to see if Open Door will be interested in buying their homes, we're seeing where some of those commission splits are different now. Right. We're seeing where the commissions that they're offering agents are changing almost by week to week at this point.
And it depends on
some of their co-ops are really, really tight. And so they are still co-oping, but we've seen where those amounts are changing, like I said, really, really rapidly, and largely because they're trying to cut a lot of expenses. So just kind of know that moving forward. Now this week, so on Tuesday, we're going to be doing our sales meeting. We don't care. Please come in and join us on any of our sales meetings. We do them all in person in all of our offices. And then on Thursday, which is weird, both Ming and I will be teaching on Thursday, just in different places.
Once in West Georgia and once in Fayetteville.
Yeah, so over in West Georgia, what are you going to be teaching?
License law, y'all need this, so please sign up.
And I'm going to do real estate marketing and technology. So basically, I'm going to be doing real estate tech and that kind of stuff over inside our Fayetteville office on Friday. So we hope that you guys, have a great week. If we can be any kind of service to you, please let us know. So love y'all.
No smoke signal.
Oh yeah. If you need us, call, text, or smoke signals. We answer it all.
Thank you. Have a happy Monday.
Bye now.